psychology is not your real problem. Your trading plan is. So let me explain that a little bit more clearly. You might feel frustrated because you've tried all these things to overcome your psychology. You've watched the late great Mark Douglas. You've maybe even read some of the books. You know to think like a casino. You try to stay disciplined and follow your trading plan. Yet there's still some panic in you when price retraces back to your entry after being in profit. And that is because at the start, your psychology is actually the symptom of what is wrong, but it's not the actual problem. Because the actual problem are the rules that you have, your trading plan. Your trading plan actually should make your psychology a lot easier to handle. And if that's not the case, which for most traders it isn't, then this video is for you. Because in this video, there is 3 things that we're going to pick out that you can immediately implement into your trading plan to make a positive impact on your psychology. I'm Arjo Janssens. I trade for investors. Next to that, I own the MMT, where we help traders that have tried many different things, but still feel stuck to get them over the hump and get them funded and payouts. Now, in order to be able to implement those 3 things successfully, I need you to understand the following. I think psychology is very important. It's crucial. In my opinion, oftentimes that's the difference between a winning, so a successful trader, and a losing trader, at least in the retail space. But we can't take all of our problems and just blame psychology. That's not how it works. So oftentimes there's a lot of important steps to take first that will directly or indirectly even improve your psychology. Again, like we mentioned, it's the symptom. It might not be the real problem at this moment in time. There's one simple solution to your psychology problems, and that is clarity. And again, this is crucial to understand because we can now really refine what the actual problem is. And the problem is usually a lack of clarity. So ask yourself, why do you get stressed? Why do you get anxious? Why do you get emotional when you're trading? It's likely because something unforeseen happened. So when you're going about your day, your usual day, and also within your trading, you have a script, consciously or subconsciously, you have a script in your mind. You have a script as to how things should plan out. And when that script doesn't play out as it should have, then it creates uncertainty. And that uncertainty, when something unexpected happens, that creates a lot of emotions. And now you can start seeing that in your trading plan as well, your trading plan is not preparing you for that uncertainty as best as it can. Because imagine in your trading plan, let's say we have all the rules that take into account all the different possibilities of what might happen. And how can you ever be uncertain if you take into account and if you know what you should do based on all these different possibilities? So for example, if X happens, I do Y. That's the rule that we need in a trading plan. But the problem is that most traders, so for example, you as well, you don't have those different rules. So you might only take into account one different possibility. Either take profit or potentially stop loss. You don't take everything into account what happens in the middle. And that's the problem. Now, I love using analogies. I think they make everything a lot more clear. Now, let's imagine that you are in this trade and this trade moves in your favor. And then it retraces back into your entry right there. And after that, it moves in your favor again. Now, you're sitting there thinking, well, do I now go break even? What do I do? And that's exactly when emotions start to rise, to start to come up. Because in your mind, again, consciously or subconsciously, you might have thought, well, this is either going to hit take profit immediately or my stop loss. Nothing in between. You didn't take into account the third possibility. And because you didn't take that into account, you don't have a rule for it. So you don't necessarily know what to do. And that's where you're now in an emotional state, and now you need to make a rational decision whilst you're being so emotional on what you should do with money on the line. And that, of course, becomes a recipe for disaster. So you see the key now, and the key is a rule for those different possibilities of what might happen. So we should first fix your trading plan, which makes it a lot easier to overcome your psychology. We're going to start doing that by number 1, Miller's Law. So back in 1956, now I'm not going to bore you with all the details, but this is important to understand. There was a person, a very smart person named George Miller. And George Miller came up with what's called nowadays the Law of 7. And essentially what the Law of 7 is that he found that the human mind can only hold up to 7 things at once in the working memory. Now later research actually suggested that that number might be closer to a 4. Now, why is this relevant? Think about your chart. So when you are already opening your chart and you're taking into account these different time frames, that's already quite tough to handle for your mind. And now imagine on top of those timeframes, which of course is perfectly fine to take into account timeframes, you take into account order blocks, breaker blocks, supply and demand, fair value gaps, the Asia session, SMT, anything you can think of. And all those different concepts that you now need to take into account on your chart, what that does is you hit a mental limit. So you don't even have a room left to focus on your psychology. And that's eventually where cognitive overload comes in. So you have many things that are fighting for little mental space. So the more clutter, the more things you have on your chart, all these different concepts that you need to take into account, the more difficult it becomes to make actual good decisions. So you could argue, in essence, that you are distracted by the chart. So the first thing that you want to implement into your trading plan is to refine. That's the first solution. Refine the concept that you are using. So find the concept that really resonates with you, double down on that concept. For me, for example, that was for fair value gaps. For you, that might be a complete different concept. It doesn't really matter. As long as you find that concept, double down on it. And what you'll notice eventually is when you double down on a concept, like I did with fair value gaps, then all these different concepts that people try to explain to you, they are already taken into account in the trading plan without having to pay conscious attention to them. My trading plan takes into account Asia session, all this liquidity, but I don't pay attention to it. It's because oftentimes what people try to do is they try to use different concepts to achieve the same outcome. Which concept stands out to you? Which concept makes the most sense to you? Which concept is where you have a feeling, okay, there's something here. I want to do some case studies around this. This is the most interesting concept to me. Focus on that concept because that concept is going to be important in step number 3, the last step we're going to go over during trading. But first, we're going to go over step number 2, which is your WOO, your window of opportunity. Now, there's essentially 2 types of windows of opportunities. We're going to first discuss the first one. The first one is a preset session. A preset session, the way you can think about that is, for example, I always trade from 9:30 a.m. to 11 a.m. New York local time. Now that might be your preset session if you are a futures trader and you trade, for example, ES or a NASDAQ and you want to be there for equities open. So the way your preset session is really going to be determined is depending on what type of trader you are. If you're a Forex trader and you like London session and you have the time to look at the chart during London session, it's going to likely be from 2 a.m. to 5 a.m. New York local time. Or for example, if you trade stocks or futures like indices, then what you can also focus on is later during the day. So a PM session, for example, from let's say 2 p.m. to 4 p.m. New York local time to bond closing hour. And what you're going to do is you're only going to see if there's a trade opportunity within that window of opportunity. Will you miss opportunities? Yes, but that's part of an edge as well. You need to eventually start picking your poison. You can't try to capitalize on everything at once. Now, a simple trick that I also like to use is if time allows you, and for example, your job also allows you to do that, I would focus on trading as early as possible in your day. The reason why I like to do that is because you're very fresh. So for example, you just woke up, you brush your teeth, you go behind the chart. You're very fresh. There wasn't any decisions that you had to make previously. So your psychology becomes very easy to handle. Now, a preset session is not for everyone. I personally don't necessarily use a preset session. The reason why I don't use it is because I'm a different type of trader. I focus more on the higher time frame as well. So for example, for a swing trader, a preset session might not be ideal because you're focusing more on the higher time frame. So what I like to do is I like to have my window of opportunity based on the alerts that I use. For example, on ES, what I like to do in my trading plan is essentially waiting for these bearish fair value gaps to be disrespected to then continue higher towards a new all-time high right there. So what do I do? Well, for my trading plan, I can then place an alert at every single step that potentially plays out. So if we overtake that bearish fair value gap, I can place an alert right there for us stinging back into that fair value gap. Then I can place another alert if we overtake the fair value gap eventually. Then for my entry, if I want to enter, for example, on a new expansion candle, I can again use an alert. This way, the same way in a preset session, I limit my chart time overall throughout the day while still being aware of what's happening. I'm just focusing on the most important part, so on the key levels. Now, step number 3 is during trading. So the reason why your psychology is also difficult to manage is because you don't actually know what you're doing during trading. So for example, I just told you right here by the use of yes, I know exactly what I'm waiting for before I look to buy or look to sell. Now, my question to you then is, do you know that? Do you know what the chart should show you in order to buy? So know what it takes in order for you to get involved. And the way you can go about that, I'll also link a video at the end of this video to help you out with that. Also, your journal in that is very important. So if you take a sample size of, let's say, 20 trades, within those 20 trades, we can actually start seeing, hey, what do the winners have in common and what do the losses have in common? And then you can clearly see, okay, there's a clear pattern to the winning trades. And when there's a clear pattern, you know exactly what you're waiting for to now look to get involved again. Now, knowing that is important, but once you are in the trade, that's also important. So for example, the analogy we used when going break even. Do you know when to go break even? Now, again, I would love to share an hour of examples right here on when you should go break even, but it really varies from trading plan to trading plan as well. And what is important to understand is your data in that, and your journal is very important in that. So for example, in the MMT, when we start taking a look at someone's journal, that's when we can really tell, hey, what you should be doing. The same way as to how you know when and where to look to get involved, the same way you know when to go break even. So if you have that sample size of trades and you see, hey, I went break even here, but all of my break evens, for example, they are actually missed winners. They don't prevent losses. Then what is important? Okay, I might want to be a little bit more loose. So potentially for now, remove the break even rule. And that way, when you're in the trade, goes in your favor, comes back to your entry, goes in your favor again, you know exactly what to do. And there's no real room for emotions anymore because you already know what to do. The next thing I would advise to do, and what can also help you during that trading, so to become a little bit more mechanical, become a little bit more objective, is this video right here. All right, perfect. Thank you.